At Grosvenor Wealth Management and HB Accountants, we think that most people just simply don't claim all of the allowances and the tax breaks that they're entitled to. And we're on a mission to let people know and claim what's rightfully theirs, and to use those allowances and tax breaks to improve their financial position for themselves and their families. Now, in this presentation, we will talk you through some of the most important allowances and tax breaks, how much they're worth, and importantly, how to access them. And as I mentioned at the beginning, we'd love to take your questions, and you can do so, as I said, by clicking on the question box in your toolbar, and then we will come along and at the end of the session, we will answer all your questions. Obviously, if we run out of time, we may have to come back to you, but the great thing here is that we'll know who's asked the question, so we can come back to you to answer your question personally. The other thing I would just say to you is that our two speakers today, who I'm going to introduce in a moment, Amy from HB Wealth is going to HB Accountants is going to be talking about the what. In other words, what are the allowances that are open to you? What are the tax breaks? And my colleague David Assor is going to be talking about how do you use those? How do you use those in your finance to make sure that you make the most of them and improve your financial position? So Amy's very much on the what, and David's on the how. Now, because this is a regulated presentation, I do need to let you know a few bits of information. So the first thing is that Grosvenor Wealth Management is authorised and regulated by the Financial Conduct Authority. This presentation today is for general information purposes and is not intended to constitute investment, tax or legal advice. We recommend that you seek independent advice before making any investment decision. Tax treatment is dependent upon individual circumstances and may be subject to change. And lastly, the value of your investments can go down as well as up, and you may not get back the original amount invested, although we're not really going to be talking too much about investment today. Right, so just to introduce the speakers to you, my colleague Amy Armitage she manages the tax department at HB Accountants, is CTA qualified, and Amy has worked in various different tax specialist roles, and her team offers a wide range of tax services, including tax compliance, dealing with tax disputes, and also tax advisory services. My colleague, David Assor, one of our financial planners at Grosvenor Wealth Management, based in Harpington, and we also have an office in London as well. And David has extensive experience in advising individuals and companies in their employee benefits and pension arrangements. He's responsible for providing advice to clients in all areas of wealth management, with a focus on helping clients to make suitable, tax-effective provision for their retirement. So, without any further ado, I'm going to pass you directly over to Amy, who's going to start off our presentation today. Hello, Amy.
Hello, good morning. So I thought we'd firstly start with the personal allowance. So this is the amount of income you can receive, so things like salary and interest, dividends, things like that, without paying any income tax. So what is your personal allowance? So the personal allowance for income tax for this tax year, which is the 21-22 tax year we're in now, is £12,570. This amount can't be carried forward into any other tax year, so it has to be used within the tax year that it's allowable. So it's really important to try and use this tax-free amount. Just a point for higher earners is that your personal allowance goes down by £1 for every £2 that your income is above £100,000. So this means that your personal allowance will be zero if your income is over £125,140 or more in the 21-22 tax year. So another really important thing to think about the personal allowance is if you're married, you can receive a marriage allowance. So the marriage allowance lets you transfer up to £1,260 of your personal allowance to your husband, wife or civil partner. This can reduce whoever receives that transfer's tax by up to £252 during the tax year. So to benefit from this as a couple, the transferor or the lower earner must normally have an income below the personal allowance of £12,570. When you transfer some of your personal allowance over to your husband, wife or single partner, you may have to pay more tax yourself, but still pay less overall as a couple. So who can apply for this marriage allowance? So you can benefit from the marriage allowance if all of the following conditions apply. So firstly, you obviously have to be married or in a civil partnership. Secondly, the person transferring over their personal allowance usually should not pay any income tax, or their income will be below the personal allowance of £12,570. So the person receiving the transfer must pay income tax at the basic rate, which generally means that their income will be below £50,000 prior to receiving the marriage allowance transfer. You can backdate a marriage allowance claim to include any tax year since the 5th of April 2017. So they think you may have been eligible for the marriage allowance. So if you think this may apply to you and you haven't received it yet, please do get in contact with One of Us, because we may be able to assist you and you may receive a refund for those years that is backdated. So next, I thought we would discuss the dividend allowance. So this is another kind of type of income tax allowance. This relates to if you hold shares in your own personal company or another company. So you don't have to pay tax on all the dividends you received. The dividend allowance at the moment is £2,000, and I don't see this going up at all. It stayed at £2,000 for a while now. It was cut from £5,000 in the 17-18 tax year and has remained unchanged since that date. So it's really important to use, if you have your own personal company especially, that £2,000 tax-free amount. Again, this can't be carried forward, so it's just that year you need to use it within that tax year you receive it. So the rate of tax paid on dividends really depends on the taxpayer's individual band. So basic rate taxpayers pay 7.5% tax on dividends. So if you earn below £50,000, you're going to pay that lower rate of tax. A higher rate taxpayer pays tax at 32.5% on dividends, and additional rate taxpayers pay 38.1% on dividends. So you can see the dividend rates are really a lot lower than the rates you pay on other income, say such as salary. So it's really important to have a think about whether you can increase the amount of dividends you receive from your company. I'm going to pass it over to David now, who's going to discuss a bit more of the financial planning options around these allowances.
Thank you, Amy, and good morning, everyone. Amy's described there 3 specific allowances that you can make best use of. When it comes to the married person's allowance, this isn't taken up as readily as it could be, and the ability to reclaim allowances from the last 4 tax years could be a valuable opportunity to save tax and put the money to good use, whether it's paying off debt, supplementing your pension or other savings, or to pay for some really important financial protections such as critical illness cover, life assurance or income protection. When it comes to the personal allowance, don't forget that the personal allowance applies to any source of income. So that's from employment or from pensions. You can reduce your tax bill once you've retired. Using pension freedoms delivers the flexibility to allow you to vary your pension income. So perhaps you could consider, in certain circumstances when you don't need all of your income, or perhaps you have certain lifestyle events that you want to save for the future, retaining some of your pension or savings in a tax efficient vehicle rather than receiving it as income. This, of course, may not be possible for everyone, especially those receiving fixed annuities or final salary pensions. In addition, you could be able to draw at least 25% of your pension as tax-free cash. So you could choose to draw some of this tax-free income and perhaps combine this with some taxable income. So don't forget to use all the facilities available to you from your pension, and speak to us or a financial advisor about personal tax planning. Finally, regarding dividends and tax, you don't need to be the owner of a large business to hold shares. Perhaps you were given them as part of an employment contract or indeed as an inheritance. But if you are a business owner and you are able to pay yourself dividends, please make sure you do this. Keep your dividend income below the annual allowance of £2,000 though. And remember, if you're running a business, employing a partner or other family members is a big benefit, if only to improve your joint income. Now we'll move on to talk about tax-free savings. Over to you, Amy.
Yes, so next we'll talk about tax-free savings. So this is mainly thinking about ISAs and your ISA allowances. So ISAs allow you to receive income and capital tax-free. So you're only allowed to contribute a certain amount to an ISA each year. And again, this can't be carried forward. So it's really important to have a think about this in the tax year. You can only take out one ISA per tax year, so one type. There's lots of types of ISAs. So for the 21-22 tax year, the ISA allowance is £20,000. There's 4 different types of ISAs. So you've got a cash ISA, which is your regular, overnight money cash deposit accounts, typically held in banks. You've got stocks and shares ISAs, which are ISAs which invest in shares and corporate, local authority and government bonds. These are higher risk and you may not get back what you invested. But not all stocks and shares ISAs carry the same amount of risk, which David will discuss in a little while. There's also innovative finance ISAs and also the lifetime ISA. So you can invest in a lifetime ISA and may receive a 25% bonus from the government. But this can only be cashed in from age 60, which is the general retirement age, or as part of a deposit on a first-time buyer purchase. So those ones were a little bit more restrictive. So you don't pay tax on money you receive in ISAs. So you don't pay tax on any interest on cash, any income or capital gains generated within a stocks and shares ISA. If you complete a tax return, you don't need to declare any ISA interest, income or capital gains on it. So that's really important that they are really tax effective investments. So you can save up to £20,000 in one type of account or split the allowance across some or all of the other types of ISAs. The only difference with this is the lifetime ISA, you can only pay £4,000 into that within any given tax year. But of course, you can take this out of your allowance and split the remaining amount across other types of ISA. I'm now going to pass over to David, who will just discuss a bit more about different types of ISAs you can invest in.
Thank you, Amy. So as we've seen, ISAs are the way to grow your personal wealth in a very tax efficient manner. This is the most tax efficient way of saving where you need access to those funds prior to retirement. Anything you put into an ISA comes from your net, i.e. post-tax income, and withdrawals are entirely tax-free and can be taken at any time. This allows you to release funds at any time before your retirement. So perhaps you are looking to pay for specific items, specific events, certain luxuries between now and retirement when you have no access to your pension. Also, as you can take out a new ISA each tax year and currently fund up to £20,000 into one, it won't take long, provided you can afford to save, to build up a healthy, tax-free source of future income. As Amy has said, there are different types of ISAs, and it's beneficial to invest in and across this wide range of different ISAs and through different investment vehicles which will hold or invest your money, spreading your risk. You're, as I said, being entitled to currently invest £20,000 per tax year. For a couple, that's £40,000, plus you can also invest for a child into a junior ISA to help with future costs, such as private or higher education. It's a nice way of building up a nest egg for your children to help them get onto the property ladder, but that's entirely up to you. Importantly, though, please make sure you seek independent advice, as the market is very crowded and not all ISAs are the same. Their performance differs and high charges will eat into your ISA account. Remember, though, that with ISAs, and particularly stocks and shares ISAs, there is a risk that you could lose some or all of your investment if performance is poor. As I said, always seek investment advice. Back to you, Amy.
Yes, so I thought we'd discuss next tax efficient share investments. So these probably aren't really commonly discussed as a tax saving option, but they can be very beneficial if you're interested in investing in shares. So we've got a few different types that the government offer. Firstly, we've got the Enterprise Investment Scheme, which is more commonly known as the EIS scheme. And we've also got the Seed Enterprise Investment Scheme, which is known as the SEIS scheme. So these schemes are UK government schemes designed to help smaller high-risk trading companies raise finance. And it does this by offering a range of tax relief to investors who purchase new shares in these companies. So how much tax relief can you claim when you're investing in EIS shares? So tax relief of 30% can be claimed on investments up to £1 million in any given tax year. This can give a maximum reduction in any 1 year of £300,000, provided you have a sufficient income tax liability to cover it. So the way that EIS shares give you tax relief is by providing you with a tax reducer. So you can have up to £300,000 tax reducer in any given tax year, and this will come off your tax bill. So it won't come off your income, it will come off your tax bill. So when you make these investments, you really need to have a think and have a chat with your accountant or tax advisor to see if you will have sufficient liability in that tax year to use that tax reducer, as you don't want to waste any of it. So with SEIS shares, similar way, it will give you a tax reducer, but tax relief is 50% and can be claimed of investments up to an annual amount of £100,000. So you're going to get a maximum tax reduction of £50,000. So next as well, there's a third type, which is a venture capital trust investment, or more commonly known as a VCT. So you get income tax relief when you buy newly issued VCTs, which is applied currently at the rate of 30% of investments of up to £200,000 in any given tax year. So you don't get this tax relief if you buy existing venture capital trusts. So it's really important you make sure it's a newly issued venture capital trust. Again, this is given as a tax reducer. So again, when you invest in any of these shares, you really need to think about what your total income tax liability is going to be at the end of the tax year. So there's some other great benefits of having EIS, SEIS and VCT shares. So firstly, with EIS and SEIS, so if shares are disposed of at a loss for capital gains tax purposes, you can elect that the amount of loss less the income tax relief you were given can be set against the income of the year in which they were disposed of, or of the income of the prior year, instead of being set against any capital gains. So that can give you potentially a refund of tax if you do sell them at a loss. So the EIS, SEIS and VCT allowances are also allocated individually. So therefore, a married couple could invest between them £2 million in EIS shares each tax year, £200,000 in SEIS shares each tax year, and £400,000 in newly issued VCT shares each year, and be eligible for income tax relief. So if you've got a year where you know you're going to trigger a big income tax liability, it would be really good to consider investing in some of these shares. So we just have a chat about timing. So you have to hold these shares for a certain amount of time to receive the relief. So for EIS and SEIS shares, they must be held for at least 3 years from the date of issue, or tax relief will be clawed back by HMRC. So you don't want to have to repay that amount. So it's really important you hold them for 3 years. For VCT shares, you have to hold them for at least 5 years to keep the income tax relief. If you sell them before this point, you'll lose this benefit. If you're connected with the company, you're not eligible for income tax relief on any of the shares you invest in. So you can't be a director or a pre-existing shareholder and then, claim to buy these shares. You won't be able to claim any tax relief. So it's really important you're not connected with the company. For EIS and SEIS shares, there's a carryback facility, which allows for all of the part of the cost of the shares acquired in one tax year to be treated as though those shares have been acquired in the preceding tax year. So relief can then be given against the income tax liability of that preceding year rather than the tax year in which those shares were acquired. So for example, if you invest in these shares this tax year, you can carry them back to the prior tax years. So it's worth having to think about, if you had a higher tax liability last year, you could invest this year and carry back. Also for VCT shares, there's another really good income tax break in which the dividends are not taxable you receive from them. So that is another thing to consider. So lastly, for capital gains tax purposes, there's also some big reliefs for investing in these shares. For EIS and SEIS shares, any gain is CGT free if the shares are held for at least 3 years and you claimed income tax relief on them. The shares can be held for much longer and therefore potentially enable the investor to accrue a big gain and not pay any tax on this, because they may, so it would be a great attraction. Again, with VCT shares, you don't pay any capital gains tax on profits from VCT shares, no matter how short of a period you have held them, provided the company has maintained its VCT status. So, you know, a lot of things to think about there from tax relief options, especially if you know you've got a year where you've got a higher income tax or capital gains tax liability. So do have to think about that. So I'm going to pass over to David now, who's going to discuss the planning options around these a little bit more.
Thanks, Amy. So as you can see, there are some very powerful and valuable reliefs available from EIS, SEIS and VCT arrangements. If you're selling a business or looking for something to supplement other tax efficient vehicles such as ISAs or pensions, this is a great opportunity to generate income tax relief, capital gains tax relief, capital gains tax deferral, inheritance tax relief, and some loss relief on any prior business losses. However, it's worth saying and focusing on the fact that these investments aren't for everybody. They are for sophisticated investors who understand the nature of the investment and the risks involved in investing in such financial arrangements. The number one risk has to be a partial or total loss of capital. Remember, if you're investing in shares, and in this case, much more directly than perhaps you are doing within ISAs or pensions, you may not be able to sell the shares quickly if you need access to your money or without a substantial loss in value. Don't forget that within the VCT structure, they are intended as a much longer term investment. You should be prepared to hold them for at least 5 years and preferably 10 or more. Shares in some small or young companies can also be harder to sell. Venture capital trusts invest in a variety of small and growing companies, including unquoted companies and those listed on the AIM market, the stock exchange, the London Stock Exchange's growth market. So really valuable tax breaks are available, but you must take good financial advice. Over to you, Amy.
So another point on allowances. So for capital gains tax purposes, if we will discuss that for a little while. So capital gains tax is a tax on the profit when you sell or dispose of something. So generally assets that have increased value. It's the gain that you make that is taxed and not the amount of money you actually receive from selling an asset. You only have to pay capital gains tax on your overall gains above your tax-free allowance, which is called the annual exempt amount. So how much CGT allowance do you have access to? The capital gains tax-free allowance for the 21-22 tax year is £12,300. This amount cannot be carried forward. So again, it's a use it or lose it scenario. You need to use it within the tax year. So you don't pay capital gains tax on assets you give or sell to your husband, wife or civil partner, unless you separated and did not live together at all in that tax year, or you gave them goods for your business to sell on. So it's really important to have a think, if you're going to sell something at a gain, you may potentially be able to transfer some of this over to your spouse and receive their tax-free allowance for capital gains tax as well. So it's really important to have a think about that. So your gain is usually the difference between what you paid for the asset and what you sold it for. There can be some situations though in which the market value is used instead. For example, when you gift an asset or sell it for less to a connected person, for example, your child. I'm going to pass over to David now, who will discuss a bit more of the planning options around this allowance.
Thank you. So important things to be aware of when it comes to using your allowances and making good use of the opportunities to make sure you don't generate a tax bill. It is worth considering the transfer of assets over to your partner to make use of their capital gains tax allowances annually. This way you can double your allowance as a couple. Also, remember that no allowances can be carried forward from one year to the next. So it's important that you realise a gain each year on your investments to use up the available allowance. With certain investments, you should consider encashing a specific slice of your gain so that you are just within your allowance, and then perhaps placing this in a tax efficient wrapper such as an ISA. Another type of investment product, an investment bond, allows you to draw 5% of the capital, the initial investment, each year whilst deferring the tax. Why is this a tax deferral arrangement? Well, withdrawals from an investment bond of up to 5% a year are allowed for up to 20 years without incurring an additional tax charge. If you don't use your 5% allowance in a given year, the allowance is carried over to the following year. So if you make no withdrawals in year one, you could draw up to 10% the following year without incurring a tax liability. So as a higher rate or additional rate taxpayer, paying 40% or 45% tax on your income in the current tax year, an investment bond allows you to minimize your income tax bill. However, your tax bill does not disappear entirely. Instead, the tax is deferred and any additional tax due will be payable at the time you cash in the bond or when it matures. Back to you, Amy.
So now we're going to discuss pensions. So pensions are really the most tax efficient investment you can have in my view. So what we're going to discuss first is pension allowances, and then go on to speak about the tax relief you can receive for making pension contributions. So firstly, if we speak about the annual allowance, so pre-retirement, your annual allowance is the limit on the amount of pension savings that can be made to your pension schemes in any given tax year before you have to pay tax on them. So you will only pay tax if you go above the annual allowance. This is £40,000 for this tax year, and it has been for a while now, so I don't see that going up or down. I think it will stay that way for a few years. So your annual allowance applies to all of your pensions if you have more than one. So this includes the total amount paid into a defined contribution scheme in a tax year by you or anyone else, for example, your employer, any increase in a defined benefit scheme in a tax year, and any amounts paid into a personal private pension or as part of any self-employment. So you do need to consider if you have more than one pension scheme, this does apply across all of them, and also includes the amount your employer pays. So you may be able to carry forward any unused annual allowances you haven't used from the prior 3 tax years. So you can only carry forward unused allowances from any tax year if you were a member of at least one UK registered pension scheme or qualified overseas pension scheme. So your annual allowance also could be lower if, for example, you've flexibly accessed your pension pot, such as taking a pension drawdown of a cash lump sum in excess of any tax-free cash, or if you have a high income. So generally this means if you're earning more than £200,000 in any given tax year. If you're earning £2,000 in the tax year, your annual allowance can be tapered down to £10,000 at the very lowest. So if you do have a high income, you do really need to consider before making any payments into a pension scheme whether you do have that tapered allowance. If you pay over the annual allowance amount you have available, you will be charged tax at your highest rate on the excess amount paid into your pension fund. So if you're an additional rate taxpayer and pay 45% on your income, you're going to pay anything you pay over your annual allowance available at 45%. So you really do need to consider your allowances before making any pension contributions. So over to David now.
Thank you, Amy. As Amy said, this is the most powerful allowance that you have at your fingertips. You may have the opportunity to boost your pension fund in ways which are not available elsewhere. Not only will you be able to place a large amount of money into a fund which grows largely tax-free, but you'll also receive tax relief at your highest rate of income tax, provided you don't exceed the allowance. And if you have been a member of a pension scheme in the prior 3 tax years and have yet to use your allowances, someone who is a higher rate taxpayer could have scope for paying a 6-figure sum into their pension in the current tax year. Putting money into a pension is also a safe harbour, as it's shielded from inheritance tax, but also remember, it is a less liquid way of saving. Your money is tied up and cannot be accessed until age 55 at the earliest, and possibly at a later age, subject to future legislative changes. Please do also talk to your financial advisor about intergenerational transfer of pension benefits on death. Back over to you, Amy.
So now we've discussed the allowances you can receive for pension purposes, we're going to go on to have a chat about the tax benefits of making pension contributions, because there are some really tax efficient ways you can save on tax by making pension contributions. So firstly, you get tax relief on private pension contributions worth up to 100% of your annual earnings. So you get the tax relief automatically if your employer takes workplace pension contributions out of your pay before deducting income tax, or your rate of income tax is 20%. Your pension provider will claim it as tax relief and add it into your pension pot. So you may be able to claim additional tax relief on pension contributions if you pay income tax at a rate of above 20%. Your pension provider claims the first 20% for you, which is called relief at source, and then you can claim additional amounts, as we'll discuss in a little while. So you may also be able to claim additional pension tax relief if your pension scheme is not set up for the automatic tax relief, so they don't claim the 20% on your behalf, or if someone else pays into your pension. So the way that you can claim tax relief in England, Wales and Northern Ireland is on your self-assessment tax return. So you can claim this for money put in of up to, you'll claim 20% up to the amount, an additional 20% up to the amount of any income you have paid 40% tax on, an additional 25% up to the amount you claimed you've paid income tax on 45% income tax on. So for example, if you earn £60,000 in the 21 to 22 tax year and pay 40% tax on £10,000, you can then put £15,000 into a private pension. You're automatically going to get the 20% tax relief at source on the full £15,000. However, you can claim an extra 20% tax relief on that £10,000 on your self-assessment tax return. This works by extending your basic rate band, so the amount you pay tax on at 20% of your tax return. So you're going to pay tax on an additional £10,000 rather than paying 40% tax, where the 20% tax saving comes from. So yes, a really good way to save tax paying into your pension contributions if you're a higher rate or additional rate taxpayer. So as we discussed earlier when we were discussing income tax allowances, the personal allowance is reduced by £1 for every £2 of adjusted net income you earn over £100,000. So this means when income is £125,140 or more, the personal allowance is going to be zero. So the effective rate for income between £100,000 and £125,140 is 60%. So any pension contributions made by an individual, whether gross contributions into an occupational pension scheme or gross contributions into a personal pension, reduce the final amount of adjusted net income, which is considered by HMRC for the amount over £100,000. So this means that you could potentially, if you earn over £100,000, receive your full personal allowance back by making pension contributions. It's also the same case for when you're calculating child benefit clawback. So if you earn over £50,000, you do get some of the child benefit you claim clawed back. Again, HMRC will consider any gross pension contributions made when considering the adjusted net income. So say you earn over £50,000, you could make a 10,000 gross contribution into your pension scheme, and this will mean that you actually have an adjusted net income of £40,000 for child benefit charge purposes. So again, it's a really good way to save money in that instance too. Finally, if we discuss the lifetime allowance, so this is the amount you can save into your pension across all schemes. So at the moment, it's £1.073 million. So you can save this amount in your lifetime across all schemes. If this exceeds the lifetime allowance, any excess will attract a tax charge of 25% if withdrawn as an income, for example, from an annuity or as a drawdown arrangement, or 55% if it is withdrawn as a cash lump sum. So it's really important to keep an eye on the amounts that you have totally across all pension schemes during your lifetime. So I'm going to pass over to David now, who again is going to discuss some planning options around these.
Thanks, Amy. It's important to remember that with pension freedoms comes the flexibility to draw your pension as and when you choose, but also some complexity to ensure that you make the best use of your allowances and the tax relief opportunities, whilst also avoiding the triggering of higher rates of tax and, in some cases, the lifetime allowance that Amy has mentioned. When you draw your pension, the first 25% is paid tax-free, and any other income will be taxed as earned income. You'll even get a P60 each year. Drawing your pension flexibly gives you more control about when and how much you draw, but it is crucial you take financial advice and perhaps run some scenarios on a cash flow basis, which will add significant value to your pension. Remember, retaining your pension and drawing from it does not mean you immediately have to use it. One point to make here is that the lifetime allowance is now frozen for the next 5 years. It's crucial that everyone understands that that doesn't mean you are going to trigger a charge as and when the value of your pension savings exceed the lifetime allowance. It will only be triggered at the point at which you draw that money that has exceeded that amount. Once you've drawn over and above that amount, you will trigger an excess tax charge. Your financial advisor can help you plan for that event and can delay it potentially up to age 75. One final thing on the subject of tax relief is that everybody has a £3,600 annual allowance for pension that receives tax relief. You can effectively give this to a child, perhaps to one of your children or grandchildren, so that by the time they start to think about providing for their own pensions, it could already be worth a tidy sum, plus they haven't had access to it. You could top that up each year as well, and it's equally useful for partners who have chosen to not work or perhaps are unable to work, especially now that you can access a personal pension from age 55.
Thank you very much, Amy, and thank you very much, David. I'm just going to chat as we sort of conclude and coming to the end of this presentation. I thought I'd just share with you some insights from Age UK. Age UK did some research and they came up with the top 10 reasons, well, mistakes that people make in terms of their pensions and in terms of their allowances and tax breaks. So I'm just going to go through those with you and just highlight those to you. So the first one was they said that people were just simply, number one, not using their allowances, particularly the personal allowance. And David and Amy earlier on talked about how everyone has a personal allowance in terms of how much they can earn in terms of income before they pay tax. So just not using that. The second one, if you're registered blind or have a severe sight impediment, you can receive a lump sum presently of £2,390. But you need to register for it. You need to contact, obviously, once you've registered as a blind person, you need to register with HMRC and they will arrange that for you. But it will not be arranged automatically. You need to contact HMRC to obtain it. Number 3, not working as a team. Now, couples can save money by giving investments to the other partner who perhaps pays a lower rate of tax. We touched on that earlier today. So remember, it has to be a real gift, not a gift in name only. So you literally do have to physically give that money or that gift to one person, to another person. If you're a married or civil partner, or one of you was born before the 6th of April 1935, you also get the married couples allowance, which will cut your tax bill. If both of you are born after 6th of April 1935, you may also be eligible for the married allowance. You may be eligible for a marriage allowance instead, but this will very much depend upon how much you earn. Number 4, not transferring the unused allowances. Again, we touched on that earlier on, but if your income is too low to use up all of your married couple's allowance or blind person's allowance, you can transfer the unused allowance to perhaps a husband, wife, or civil partner. So remember, to do that, contact us and we will help you guide you in doing so. Paying tax when you don't need to. Number 5, all basic rate taxpayers have a personal savings allowance of £1,000. This means that you do not pay tax on the first £1,000 of interest that you receive on all of your combined savings. If you're a high rate taxpayer, the personal savings allowance is £500. If you're an additional rate taxpayer, then you don't receive it at all. And banks, you may be aware now that banks and building societies no longer deduct tax at source as they used to in the past, as you probably remember, but you will instead get that personal savings allowance. You need to, again, make sure that you receive, although interest rates are not terribly good at the moment, to be fair, but make sure that you use your personal savings allowance as well and get as much interest tax-free that way. Number 6, not claiming basic back overpaid tax. Now, it's incredible the numbers of people these days who do pay overpaid tax, and that's because they're perhaps so busy with their normal lives that they may not think about it. But if you pay too much tax, perhaps because you've failed to claim an allowance or tax relief, or because too much tax has been deducted from your income, you usually can claim back a tax relief within 4 years of the end of the tax year in question. Now, if you're not sure, if you think that potentially you could be claiming back tax, then clearly please get in contact with Amy or indeed David, who can give you some guidance on that. Number 7, not checking your tax code. Now, your tax code, which appears obviously on salary slips or wage slips, tells your pension company or indeed your employer how much tax to take from you, and how much, most importantly, how much of your income is tax-free. So it's really important that you check that you've got the right tax code. Now, you might say, well, how would my tax code change? Well, if you're paying, for example, contributions to a charity or an association, you may well be able to get a reduction in your annual tax bill, which HMRC would effectively reduce your tax code. And the way they would give you that tax relief, tax back, is by reducing your tax code. So it's important to let HMRC know that, particularly for payments to charities, that you have done so. That means that you effectively get that income back. Number 8, not informing HMRC when your working hours change. Now, if you're changing your hours, please tell HMRC, particularly obviously if you're working. They may need to adjust your tax code. Be particularly careful if you have a job as well as a pension. A lot of people these days have income, 2 sources of income, and very commonly the wrong amount of money is deducted. So it's important that you speak to Amy or David about making sure that the right amount of tax is being deducted across the board. Just moving on there, number 9, forgetting to tell HMRC that you're soon to be retiring. Make sure your tax office knows in good time if you are expecting to receive a pension. And it's important that your pension company knows what your tax code is. Now, they won't know at the outset what your tax code is, and they will automatically deduct emergency rate tax from your pension. Now, that's inevitable in the first month, but make sure that you provide that information to your pension company at the earliest opportunity so that they can correct that for you. And obviously, you should contact HMRC to arrange for any correction as quickly as possible, And from our experience, HMRC are very good at doing that. Lastly, there, number 10, putting off your tax return. Now, if you're like me, you would have received a notification to do your tax return for the last tax year. So you would have got something through the post to say, don't forget to do your tax return and it's got to be done. If you're going to do it by paper, it's got to be done by the 31st of October this year, or if you're going to do it online, 31st of January next year. But don't leave it too late. Obviously, if you miss the deadline, there's automatically penalties that could be applied. But I think more importantly than that, it may take some time for you to gather all the information necessary for you to complete your tax return accurately. And again, speak to HB accountants or indeed us at Grosvenor Wealth Management for us to help you to prepare for that. So hopefully you found that useful today. I'm now going to just check to see if there's any questions that have come through. We have got a few questions there, so I will just open those up. Let's see here. I'll just open that up, and then what I will do as well is I'll just, if there are any people that would like to ask a question live to either Amy or David, then I will do so. So I'm going to read out the question here, and then we'll see who that might be suited to, who's the best person to answer that. So the first question, if I wanted to release money from my investment without paying tax on the amount withdrawn, how do I go about doing it? So David, do you want to have a crack at that one?
Okay, I suppose it depends what type of investment it is. Some investments will have to withhold a certain amount of tax, so that may happen automatically. Obviously, if you want to reclaim the tax because you feel that you have an allowance that you can use, that can be done as well. It would make sense to refer this to either an advisor or to the investment company itself to help you with making sure that there is not only is there no tax due, but also that the investment is paid without tax initially. Obviously, if there is tax due at a later date, you can always make that payment via your personal tax return at the end of the year.
And I think it very much depends, I guess, on the nature of the actual investment itself, the type of investment that we have here. I think it's down to that. I think what was highlighted earlier on is some products allow you to take income tax, take tax withdrawals, tax-free withdrawals with no problem, such as ISAs. Others, in particular bonds, will be you're in a situation where it will very much depend upon how much you withdraw in terms of whether you actually trigger what's called a chargeable event, where you may then incur tax. But again, even the way products are structured these days, depending upon how the product is structured, you may simply be able to take a certain amount out without incurring a tax charge. So there's a number of products to do that. Obviously, on pensions, David, I guess in terms of drawing money out of a pension, if you see it as that way, then yes, you could take money out of a pension.
And I think that's a crucial point as well, thanks Nick, is that there are certain investments like pensions where there are certain ways of withdrawing money where you don't have to pay tax upfront or at all. So it's worth, as I say, speaking to your advisor or the product provider to see what the options are about different types of ways of drawing your benefits. One of the things that we see often, which can be quite frustrating, is that individuals have triggered payments where a tax has been paid which could have been avoided.
Yeah. So Patrick, I hope that's answered your question there.
Just to add to that, if you do trigger, take a pension amount that shouldn't have been paid, you can reclaim that from HMRC, because we have been able to do that for a few clients. So if you do, you've done that without having a chat with your financial advisor, then do, speak to your accountant, because they may be able to reclaim the money from you from HMRC before you submit your tax return. Just to add. Okay.
Brilliant. Well, thank you very much, Amy, and thank you very much, David, indeed, for taking us through today's presentation. As I mentioned at the beginning, we will contact you after today, really just to answer any questions that you have personally, or to give you any further information that you might need. I think we fully appreciate there's lots of facts and figures presented to you today, and I'm sure that it will take time for you to fully consider what that means to you personally. So we're here to kind of answer your questions and to give you a bit of guidance, I suppose, if you would like us to provide that guidance. And that is completely complimentary, and we'd be very happy to do so. So I'm just going to leave it there today. As I said, thank you very much, David, for our presentation, for attending and presenting today. Amy, thank you very much indeed, again, for presenting today. And we very much look forward to speaking to everyone who's attended today at some time in the foreseeable future. And I wish you the very best of luck for the rest of this year, and we hope you enjoy the rest of your day. Thank you. Bye-bye.